Greetings, everybody. Welcome to Liberty Call. Today is Tuesday, June 27, 2023. Hope everybody's having a fantastical day out there. I am Raymond Dahlman, your humble host here at the Liberty Call. Hope you're having a great day. It's my good buddy Jake back here sitting over my shoulder. He is wanting to go play outside because it is another beautiful day here in Colorado. A little more clouds today, but a little warm. It's about 83 degrees, but I guess if you're watching this down in Texas, you probably would trade some low 80 degree temperatures for the sweltering conditions y'all have down there right now. So anyways, all right, if it's your first time watching Liberty Call, I'm glad you're here. Thank you very much. Jake is glad you're here too. Please give me some thumbs up, like, share, subscribes, follows, all that good stuff. Press all the buttons down here. Share with all your friends and family. I would greatly appreciate it. Thank you very much. All right, let's go ahead and jump into the numbers for today. Seems like the markets seem to in a much better mood. Dow Jones was up 0.63%, 212 points, closed at 33,926. The S&P 500 was up 1.13%, closed at 43,77. NASDAQ was up 1.65%, closed at 13,555. The VIX fell 3.37% today. It's down to 1377. Canada was up 0.74%. Brazil was down 0.53%, and Mexico was up 1.12%. Headed over to Europe, Germany was up 0.21%. The UK was up 0.11%. France was up 0.43%. Netherlands was up 0.4%. Spain was up 1.28%. Italy up 0.58%. Switzerland flat, up 0.01%. And Portugal up 0.03%. Russian exchanges both green today. MOEX up 0.71%. The RTSI up 0.67%. And the overnights in Asia, the Nikkei in Japan was down 0.49%. Australia up 0.56%. New Zealand flat, up 0.06%. In China, the Shanghai was up 1.23%. The Shenzhen component up 0.97%. China A50 up 0.51%. DJ Shanghai up 1.09%. Hang Seng up 1.88%. And the Taiwan weighted down 1% even. All right. So like I said, markets seem to be in a little bit better of a mood today after last week and and filtered into Monday with all the downtrend after the Fed meeting, which disappointed a lot of people out there in the markets, unfortunately. So, all right, well, let's go ahead and jump into today's market recap. Stocks are rising after strong economic data overcomes recession fears. U.S. stocks experienced a rebound as positive economic data and a surge in mega-cap stocks alleviated concerns about a looming recession. The Dow snapped a six-day losing streak with a winning session, although Walgreens saw a decline of 9.4% in its shares after reducing its fiscal year profit outlook due to a decrease in demand for COVID vaccines and tests. Optimism prevailed as economic data surpassed expectations. Durable goods orders rose 1.7% in May, defying the anticipated 1% drop, indicating solid business spending. Core goods orders also exceeded expectations, rising by 0.6%. Additionally, consumer confidence stood at 109.7, surpassing the predicted reading of 104. And new home sales outperformed forecasts with an annualized rate of 763,000 compared to the expected 675,000. Fears of a potential recession had caused stocks to stall on Monday, even though the Federal Reserve had paused on interest rates in its recent meeting, but suggested the possibility of another rate hike or two, potentially in July, in its ongoing battle against inflation. Investors remain concerned about further rate hikes could push the economy towards a recession, although Wall Street economists have adjusted their expectations downward in recent weeks. The Fed emphasized that it bases its decision on data, and this week's key report on inflation numbers for May will be closely watched, with an expected rise of 4.6% in personal consumption expenditures index. Futures traders are indicating a greater than 75% probability of a quarter percentage point rate hike by the Fed in July. Investors have the opportunity to gain further insight from top policymakers at the European Central Bank Forum in Portugal, including a speech by Fed Chair Jerome Powell. I bet that would be really exciting. Jerome is a very exciting person. With June coming to an end, along with the second quarter, the three major indexes are poised to record gains for the period. However, Lordstown Motor Corp, an electric vehicle manufacturer, saw a 25% drop in its shares as it filed for bankruptcy protection and put itself up for sale due to an unresolved dispute over an investment from Taiwan-based manufacturer Foxconn. Conversely, shares of cloud analytics company Snowflake Inc. rose 4.6%, following an agreement with NVIDIA allowing customers to develop artificial intelligence models using their own data. All right, so that was the market news for today. Let's go ahead and dive a little deeper. U.S. consumer confidence races to 17-month high, housing market regaining strength. Consumer confidence in the U.S. reached its highest level in nearly a year and a half in June, indicating renewed optimism in the labor market and a resilient economy, despite concerns of a recession. This positive sentiment was further supported by reports of a revival in the housing market, with new home sales reaching a 15-month high in May and monthly house prices showing an increase in April. The encouraging economic data suggests that the Federal Reserve may need to continue raising interest rates to manage demand in the overall economy. The central bank, which has already raised rates by 500 basis points since March of last year, signaled the possibility of 2 additional rate hikes this year. That would be July and the September meeting. The conference board reported that its consumer confidence index rose to 109.7 in June, the highest reading since January of 22, exceeding economists' expectations. The increase in confidence was primarily driven by consumers under the age of 35 and those with an annual income of more than $35,000. While consumers still expected a recession within the next 6 to 12 months, they displayed a more positive outlook on the labor market, with more perceiving jobs as plentiful and fewer finding jobs hard to get. That's in quotes. They may find it harder once those jobs dry up. It just might be because jobs are a lagging indicator. I know I say this over and over and over again, but jobs, spending, all those are really lagging indicators. You really won't see it until things get tough. You know, businesses are laying a lot of people off and money's tight. So anyways, where was I? Although income expectations slightly eased, consumers remained optimistic about their family finances. Additionally, their 12-month inflation expectations dipped to 6%, the lowest reading since December of 2020, indicating confidence in the declining inflation rate. However, consumers' buying plans showed a softening, particularly for motor vehicles, major appliances, houses, and vacations. Economists caution that buying plans do not necessarily correlate strongly with consumer spending. The positive economic news led to higher trading in U.S. stocks, while the dollar declined against other currencies and U.S. Treasury prices fell. Furthermore, the Commerce Department's separate report revealing that that orders for non-defense capital goods, excluding aircraft, a proxy for business spending plans, increased by 0.7% in May. Despite a downward revision in April's figures, business spending remained resilient, with notable increases in orders for electrical equipment, appliances, components, and machinery. Shipments of core capital goods also showed gains, suggesting a potential bottoming out in spending and upside for second quarter equipment spending. The housing market showed signs of stabilization and a potential recovery. New home sales surged by 12.2% in May, the highest level since February of 22, benefiting from scarcity of previously owned homes available for sale. Additionally, monthly house prices rose by 0.7% in April, supporting the overall strength in the housing sector. The positive economic outlook, particularly in consumer confidence and the housing market, present risks to the Federal Reserve's goals of achieving 2% inflation over the medium term. This suggests the possibility of further rate hikes sooner rather than later, aligning with the base case scenario of many economists. So, things still remain rather strong, which, again, leads us to believe that the Fed is going to continue their rate increases and tightening of the economy. So, not really shocked. All right, last article comes from Zero Hedge, titled Morgan Stanley Sees First Negative Payroll Print in August or September. That does not sound like good news. Morgan Stanley's chief economist, Ellen Zentner, made a sudden reversal in her stance on the Federal Reserve's interest rate hikes. After previously declaring that the hiking cycle was over, Zentner now believes there is a significant possibility of a rate hike in July and has revised the bank's policy path accordingly. This revision includes an upward shift to 5.375% for the federal funds rate by the end of 23 and 4.375% by the end of 24. While Zentner's assessment may not appear bullish at first glance, it aligns with the notion that the Fed's aggressive rate hikes aim to accelerate a recession and control the inflation triggered by its policies in 2020 and 21. By adding another rate hike to its forecast, Morgan Stanley implies that the economy may enter a stall speed more quickly than anticipated. Zentner acknowledges concerns about the negative payroll print, with clients frequently asking about its likelihood. She now forecasts a significant slowdown in monthly non-farm payroll growth, dipping below the replacement rate of 90,000 in the fourth quarter of 23 and hitting a low of 40,000 in January of 24. Although job growth is expected to gradually improve, Zentner notes that a negative payroll print is highly likely, particularly considering the pre-pandemic particularly considering that pre-pandemic, a standard deviation decrease in non-farm payroll growth was around 200,000. According to Morgan Stanley's forecast, either August or September could potentially mark the first negative payroll print. Zentner emphasizes that if this were to occur, risk-off sentiment in the financial markets may surge, especially as investors remain cautious about a possible recession, despite the narrative of a soft landing gaining strength. The Federal Reserve, however, is unlikely to react swiftly to a negative payroll print, as more supporting evidence would be needed, and their decision-making process is characterized by low-frequency decisions in a high-frequency world. In summary, Morgan Stanley's sudden reversal on the Fed's interest rate hike suggests a higher likelihood of a rate hike in July. Zentner's forecast also indicates a potential slowdown in job growth, with the possibility of a negative payroll print, which could significantly impact market sentiment and raise concerns of a looming recession. So that is not good news. That everyone else out there the people at Morgan Stanley seem to think that we are headed towards some rocky or some rough seas ahead of us. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.